Suzlon Energy has successfully replaced a legacy of distressed, debt-laden operations with a massive 65,000 crore market capitalization. To determine if that valuation is supported by more than just sentiment, we are conducting an institutional-grade audit of the company's current position. The macro environment for wind energy in India is reaching an inflection point. NITI Aayog is pushing for revised models that mandate local content, while the Ministry of Power's waiver of interstate transmission charges, or ISTS, has significantly improved project economics for developers. This chart shows the resulting market concentration. Suzlon's 15 gigawatts of installed capacity represents a dominant domestic position, significantly ahead of Siemens Gamesa at 8.9 gigawatts and Inox at 3.1. That scale is currently backed by a massive 5.9 gigawatt order book. Importantly, 66% of these orders come from commercial, industrial, and public sector clients, which reduces the risk of customer concentration. While these macro tailwinds and the current order book provide a long runway for growth, scale alone does not guarantee a sustainable economic moat. We have to look at the revenue architecture itself. The current vertically integrated model draws from three primary streams. The sale of wind turbine generators accounts for 62%. The company plans to scale annual renewable energy sales to 10 gigawatts, while increasing assets under management to 70 gigawatts. This strategy moves Suzlon beyond pure wind manufacturing. They are introducing a dedicated development company, or DevCo, to secure project sites, and launching a battery energy storage segment to handle grid intermittency, opening a new frontier in reliable power delivery. This blueprint demands a four-fold expansion of the current business. To see if that growth is achievable, we need to check the most recent quarterly execution and see if the balance sheet can actually fund this pivot. We begin the micro-level audit with the recent financial statements. We're looking for evidence that the massive order book is converting into operational cash. In Q4 of fiscal 2026, Suzlon delivered 830 megawatts, the highest quarterly delivery ever recorded in the Indian market. This volume drove record full-year revenue and profit after tax. This table shows consolidated results for the first quarter. Total income was 3,862 crore rupees, with a net profit of 305 crore. Compared to the previous quarter's 1,114 crore profit, we see a sequential decline, reflecting the standard seasonal reality of wind project execution. This segment reporting confirms the revenue mix for the quarter. Renewable energy solutions generated 3,174 crore, while RE Asset Management, the high-margin service arm, contributed a stable 631 crore. The quarterly numbers confirm that operations have reached a profitable baseline. Now we have to determine if the market's current valuation multiples have already priced in a perfect execution of the 2.0 plan. Based on fiscal 2026 estimates, Suzlon trades at a premium, carrying a price-to-earnings ratio of 38.6 and an EV to EBITDA multiple of 30. For a heavy manufacturing firm, these are high multiples. To justify this, the underlying financial structure must show a significant change in capital efficiency. That change is the removal of legacy debt. By paying down obligations, Suzlon has reduced interest expense and its debt-to-equity ratio to 0. The company is now net cash positive by 2,384 crore rupees. This removes the primary friction that previously stalled their growth. This chart shows the impact on capital efficiency. With no interest burden, return on equity is projected to rise from 28% in fiscal 2024 to 36% by fiscal 2027. Structurally, the order book is also shifting. 28% of current orders are for engineering, procurement, and construction contracts. These turnkey solutions are helping improve working capital cycles and inventory management. A zero-debt balance sheet and rising capital efficiency provide the mathematical justification for a premium valuation, assuming the forensic checks remain clear. We've checked the forensic data. Auditor fees have grown at a rate consistent with revenue, indicating that audit complexity is scaling alongside the business. Shareholding patterns also show stability, with institutional holdings from both domestic and foreign funds remaining steady through the recent quarterly volatility. One area for continued monitoring is the level of promoter pledging. While the business is growing, high levels of pledged shares can create technical risks for the stock during market corrections. For asset quality, we track return on assets. As Suzlon executes its 5.9 gigawatt order book, this metric is showing a steady upward trend, confirming that the company is extracting more value from its capital base each year. The fundamental and forensic audit shows no immediate red flags. This leaves technical analysis and regulatory hurdles as the final variables in our verdict. The most significant regulatory risk is the scheduled expiration of ISTS waivers in June 2025. If these waivers are not extended, it could increase costs for developers and impact Suzlon's order intake momentum. Compared to peers like Wari or Inox, Suzlon's massive service network and R&D centers in Europe and India provide a competitive cushion. These assets help sustain a slight valuation premium despite sector-wide policy risks. To see if the market is currently buyers or sellers of this risk, we turn to the price action. This chart shows Suzlon's recent price action on the NSE. The stock is currently consolidating after a year of rapid appreciation. Looking at the 20, 50, and 150-day moving averages, the price finds support near these key levels, suggesting institutional accumulation remains steady. The technical structure is consistent with a fundamental recovery. Now we can apply these data points to a final valuation model. We break the future projections into 3 probability scenarios. The bear case assumes execution delays and the removal of ISTS waivers, which would lead to a contraction of the current PE multiple. The base case assumes the steady execution of the 5.9 gigawatt order book, maintaining current margins and market share. In the bull case, the company hits its Suzlon 2.0 targets early, and the new battery storage segment begins contributing significantly to the bottom line. Based on the current 65,000 crore market cap, the central question is whether the stock can deliver a 15% compound annual return over the next 5 years. Research from Motilal Oswald suggests that target is achievable, citing the zero debt structure and the scale of the order book. They have issued a target price of 70 rupees, representing a 21% upside from current levels. Suzlon ends the fiscal year debt-free, with the operational capacity to support its next growth phase. By removing legacy financial friction and securing a high-quality order book, the company has positioned itself as a market-leading renewable energy compounder.